Welcome back to Finance Plus Investment. Today, we're diving into everything you need to know about applying for business loans. Whether you're just starting out or looking to expand, securing funding is crucial. We'll cover everything from understanding different types of loans to what lenders look for in an application. By the end, you'll have the knowledge and confidence to secure the funding you need. Let's get started. First, let's talk about the different types of business loans. Understanding the variety of loans available can help you make an informed decision that best suits your business needs. SBA loans are partially guaranteed by the Small Business Administration, known for low interest rates and long repayment terms. These loans are ideal for small businesses that may not qualify for traditional bank loans due to limited credit history or collateral. Term loans involve borrowing a lump sum and paying it back over time with interest. They're typically used for significant investments like expanding operations, purchasing real estate, or other large capital expenditures. Lines of credit are flexible, like a credit card for your business. They provide access to funds up to a certain limit, which you can draw from as needed. This is particularly useful for managing cash flow or covering unexpected expenses. You borrow up to a certain amount and only pay interest on what you use. This flexibility makes lines of credit a popular choice for businesses that need to manage variable expenses or seasonal fluctuations. Equipment financing is for purchasing expensive machinery or vehicles. This type of loan is secured by the equipment itself, making it easier to obtain even if your credit isn't perfect. Invoice financing uses your outstanding invoices as collateral. This can be a great way to improve cash flow without waiting for customers to pay their invoices. Each loan type serves different needs. It's important to understand the specific benefits and drawbacks of each option to determine which one aligns best with your business strategy. So, how do you know which one's right for you? Start by assessing your business's financial health and future goals. Consider factors like your credit score, the amount of funding you need, and how quickly you need access to the funds. It all comes down to your specific business needs. Whether you're looking to expand, manage cash flow, or invest in new equipment, there's a loan type that can help you achieve your objectives. Consider how much money you need and what you can afford to repay. Look at the terms and conditions of each loan type, including interest rates, repayment schedules, and any fees involved. Choose the loan that aligns with your goals. By carefully evaluating your options and understanding the specifics of each loan type, you can make a decision that supports your business's growth and success. Now let's talk about qualifying for a business loan. Securing a business loan can be a pivotal step in growing your business, but it requires meeting certain criteria. Understanding these requirements can significantly improve your chances of approval. Lenders want to see that you're a good risk and will repay them. They assess various factors to determine your creditworthiness and the likelihood of your business succeeding. Your credit score is crucial. It shows how responsible you are with borrowing and repaying money. A high credit score indicates that you have a history of managing your debts well, which reassures lenders. The higher your score, the better your chances of approval. Typically, a score above 700 is considered good, but the exact requirement can vary by lender. Lenders also look at your business's financial history. They will review your financial statements, including income statements, balance sheets, and cash flow statements, to gauge the financial health of your business. They want to see a track record of success and sufficient cash flow. Consistent revenue and profitability over time can demonstrate that your business is stable and capable of repaying the loan. Another factor is your debt-to-income ratio. This ratio compares your monthly debt payments to your monthly income, helping lenders understand your ability to manage additional debt. Lenders want to ensure you can comfortably afford a new loan. A lower debt-to-income ratio is preferable, as it indicates that you have more disposable income to cover new loan payments. They might require collateral, an asset you put up as security. Collateral reduces the lender's risk because it provides a way to recover their money if you default on the loan. If you default, the lender can seize the collateral. This could include valuable assets like real estate, equipment, or inventory. The value and type of collateral required can vary depending on the loan amount and the lender's policies. Meeting these criteria improves your chances of getting a loan. By understanding and preparing for these requirements, you can position your business as a strong candidate for financing, paving the way for future growth and success. Now, let's figure out where to find these loans. Whether you're a startup or an established business, securing the right loan can be a game changer. The right loan can help you expand operations, invest in new equipment, or manage cash flow more effectively. But where do you start looking? Traditional banks are a common option if you have a strong credit history. They offer a variety of loan products, from short-term loans to long-term financing. However, the application process can be lengthy and requires substantial documentation. Credit unions offer lower interest rates and personalized service. They are member-owned institutions, which often means better customer service and more flexible terms. However, you usually need to be a member to apply for a loan. Government programs like those from the SBA have flexible criteria. These loans are partially guaranteed by the government, making them less risky for lenders. This can be a great option if you don't qualify for traditional bank loans. Microlenders provide small loans to startups and small businesses. They often focus on underserved communities and offer loans that larger institutions might not. These loans can be a lifeline for new businesses needing initial capital. Online lenders offer a fast and convenient application process. With just a few clicks, you can apply for a loan and get approved within days. They often have more flexible requirements than traditional banks, making them accessible to a wider range of businesses. However, it's crucial to read the fine print. Some online lenders may charge higher interest rates or fees, so it's important to understand all the terms before committing. However, research and compare rates and terms before committing. Look at the total cost of the loan, including interest rates, fees, and repayment terms. This will help you make an informed decision and avoid any surprises down the line. Each option has its pros and cons. Traditional banks offer stability, while credit unions provide personalized service. Government programs offer flexibility, and microlenders focus on small loans. Online lenders offer speed and convenience. Choose the one that best fits your business needs. Consider what you value most, whether it's low interest rates, fast approval, or personalized service. Your choice will depend on your specific circumstances and business goals. Consider factors like interest rates, fees, and repayment terms. These elements will affect your monthly payments and the overall cost of the loan. Make sure you can comfortably meet the repayment terms to avoid financial strain. Finding the right lender is crucial for securing the best loan. Take your time to research and compare different options. Speak with advisors or financial experts if needed to make an informed decision. Make an informed decision to support your business growth. The right loan can provide the financial boost you need to take your business to the next level. So, choose wisely and set your business up for success. So, you've found a lender and you're ready to apply. Well, gather your paperwork, starting with your business plan. Include financial projections and how you'll use the loan. Provide financial statements like income, balance sheet, and cash flow. Lenders need a snapshot of your business's financial health. Share information about yourself and other business owners. Depending on the loan, you might need to provide collateral. This could be real estate, equipment, or inventory. Be prepared to sign a personal guarantee. Understand what you're signing and the commitment involved. Having these documents ready will streamline the application process. Now comes the moment of truth, applying for the loan. Start with a pre-application, a high-level overview of your business. If you pass, submit a formal loan application with detailed information. The lender will review it and may ask for additional documentation. They might schedule a call to discuss your business in detail. After due diligence, they'll make a decision on your loan. If approved, they'll send a loan agreement outlining the terms. Read the agreement carefully and ask questions if needed. Once you're comfortable, sign the agreement and finalize the loan. You're now ready to receive the funds and grow your business. Congratulations, you've secured funding for your business. Before celebrating, understand the terms of your loan agreement. Know the interest rate, repayment period, fees, and default consequences. Ensure you can comfortably afford the payments. Once finalized, the lender will disperse the funds to your account. Use the money for its intended purpose, like purchasing equipment or expanding operations. Stay on top of your loan payments. Set up automatic payments or reminders to avoid missing payments. This helps protect your credit score and maintain a good relationship with your lender. Properly managing your loan is key to your business's success. So there you have it, a complete breakdown of how to apply for business loans. Securing funding can be a game changer, but do your research and choose wisely. If you have questions, drop them in the comments below. Don't forget to like and subscribe for more videos on growing your business. Thanks for watching.